All right, everybody. How we doing today? Welcome back to another live with me. Today is Mortgage Boss Talk Tuesday. As promised, that I would come and answer all of your questions about home buying, anything you want to know about being a mortgage loan officer. But on this special episode, I am sure that you have heard about some volatility and some breaking news that we've had in the world of finance since Friday. Y'all, oh my God, things have been interesting to say the least. If you work in this world, then you will know that it has been popcorn worthy. My God. So, we're just going to talk about it a little bit in terms of how this information regarding the SVB bank collapse has anything to do with you or with the way that the housing market is going to go. Anyway, as you guys come on in, go ahead, please do me a favor and hit that like button for engagement. I want to get my engagement numbers up while I'm trying to build this sense of community here. Also, make sure you share this with a friend. And if you are new here, thank you so much for popping by to learn a little bit about what can typically be something boring, but we'll get some laughs, I promise you. Also, make sure that you do subscribe if you have not been here before. So, anyway, guys, we're going to keep this to about an hour. And I did ask people over on my Instagram page to send me some questions. So I'll be answering those questions. I was a bit surprised by how many responses I got, but I'll try the best that I can to get through those. If for whatever reason you have a question while we're talking, please make sure that you put that in the chat below. Because of the complexity of this topic, I wanted to make sure that I did a lot of research and I got everything that I possibly could correct. I don't want any misinformation because it's way too much of that out there. So if I don't know, I'm gonna tell you, I don't know. I don't know. But if I do, then I will be sure to address those things with you. The goal here is just to give you a little bit of background. And like I said, just provide some context in terms of what does that have to do with the housing market and, you know, if it's a good time to buy a house. Y'all already know what I'm going to say about that. So. All right. So I'll tell you, last time we heard of a bank failing, I feel like it was in 2008. It was a while ago. At least we thought it was a while ago. Believe it or not, banks, they fail all the time. And so this isn't anything that's new. It isn't the first time this happened, and it won't be the last time that it will happen. However, I want to just show you here. I'm going to try to show you a graphic just so you can see what let me see. I want you to see what banks or how many banks have gone out of business in the last several years. It's not allowing me to show it to you. Well, that sucks. Okay, so anyway, leave. It's not letting me do it. Okay. Well, that's not the end of the world. It's not a big deal. But I'll just read the data to you. So, y'all, we have had hundreds of banks that have gone under, so to speak, in the last since 2008. Hundreds of banks have gone out of business since 2008. This bank, SVB, which is Silicon Valley Bank, is the 16th largest bank that we have currently now today. So back in the day, you may have heard something like, oh, well, banks are too big to fail. Well, in this case, it's not a matter of it being too big to fail. We have really four banks that are considered to be like entirely, their reach is entirely too far, too deep to allow for something to happen, because if they were to go down, then businesses, mortgages, consumers, a little bit of everybody would be touched, and it would be catastrophic. SVB Bank is the epicenter of startups for techs. So if you've heard of companies like Etsy or Roku, those are some of the companies that Silicon Valley Bank was involved with. Now, you may have also heard that over the weekend, it was more than one bank that went under. The other bank was Signature Bank, and they focused more on capital for law firms, but it wasn't nearly as large as SVP. So we're just going to keep a very narrow focus about this. So just a little bit of background, like, how did we get here? It looks like, and it even sounds like, based on some of the things that the executives have been saying, some of the things that things have been coming out of Washington, D.C., saying, oh, well, we had no idea. We didn't know this was going to happen. We were just as surprised as you. Yeah, right. This whole thing unraveled in seemingly 48 hours. So what happened? At the end of 2022, which was only 90 days ago, this bank had $175 billion in total assets. I'm sorry, deposits. Now, one thing that makes a mortgage lender different from a bank is that we don't take deposits for savings accounts and checking accounts and things like that. The way that banks make money is they make money off of the money that you put into your bank accounts. And I'll kind of get you a little bit of detail about how that works, because what a lot of people don't realize is it's really funny when people want to like go rob the bank. The bank don't have no money. Like, literally, they don't have millions and millions of dollars. The way that the banking structure is set up, they're only required to hold about 10% of their deposits. That other 90% goes back into the market and reinvest it in a way to be able to get them more money so they can make money off of your money. Well, on Thursday, they had about $42 billion in withdrawals. And the word got out. They was like, what's going on? People found out that, the bank was a little bit overly exposed, and there was what's called a run on the bank. Effectively, people started to panic. There was whispers, hey, did you hear that they only have, such and such amount of money? Hey, did you hear that so-and-so's getting their money? Hey, and it created an emotional response, which I don't know if it's fair or not, but I think it's fair. Human beings, particularly when you're talking about millions of dollars, tend to get a little uptight about their money. And so what happened was people ran to the bank and pulled their money out. And I saw an interview where a guy said that he had a conversation and was like, hey, so-and-so, go get my money. And they said, well, I don't know. I don't think we should. Like, let's, not damage our relationship with SVB. He said, no, I said what I said. Go get my money now. And they quickly realized they needed to listen. They went, got the money, deposited somewhere else. So at the beginning of 2020, which was only 3 short years ago, when we had the coronavirus starting and all the things, before the rates plummeted the way that they did, this bank only had $27 billion in securities. But by the end of 2022, it ballooned to $128 million in securities. And so when everybody started going to get their money out of the bank, they ended up trying to sell off some of those treasury securities. They wanted to sell off what it had invested all this money. But the problem was interest rates have been up for the last year and some change now. And so they had to sell at a loss. And so they ended up taking $2 billion in losses, and panic ensued. When people heard about these losses, these unrealized losses, they were like, ain't no way, I'm not getting caught up in this. Absolutely not. And so what we thought was going to happen when the FDIC got involved and said, okay, well, things ain't going so good over here. We don't have to shut this down. And what we thought was going to happen was this was the beginning of the dam breaking. If you were with me last week, I talked to you a little bit about the Fed's desire to raise the rates even more rapidly and more aggressively than he's been raising the rates in the past year, because he wasn't seeing inflation come down as quickly as he wanted to. Well, the idea is, and I jokingly but not jokingly say, you are really rooting for unemployment. That is the goal. Like we're like, yes, like when people start losing their jobs, this is going to be a good thing. Well, okay. Well, as it happens, looks like, with this bank going out of business and it being a commercial bank. And I want to clear this up. When I say a commercial bank, I mentioned that they are there for tech startups. This is not, Joy depositing, her paycheck every 2 weeks. It wasn't that type of bank. This was for companies that had millions and millions and millions of dollars of exposure that they had deposited into the bank. And so what I remember I saw this on Saturday. I don't know what I was doing on Friday that I missed this, but I saw this on Saturday and I was reading through it and I thought to myself, oh my gosh, like this is going to be a disaster. These companies are not going to be able to make payroll on Monday or next Friday or whatever the day is. These companies are not going to have any money in their accounts. They're not going to be able to do anything because the money that they deposited wasn't going to be insured. Well, I thought surely these companies going to go out of business and boom, here we go. We're on our way to getting back on track and getting out of these 7% interest rates that I've been quoting people. But no, this was a very interesting turn of events. So, whereas we thought, or I thought anyway, that this would begin a wave of unemployment because people would be out of companies would be out of business and that they wouldn't be able to make payroll. And I want to be real clear, like what companies, I just give you a few: Roku, Etsy, Roblox. My kid loves Roblox. BuzzFeed, and some others. Those were the ones that jumped out at me. Tens of millions of dollars, hundreds of millions of dollars. Roku had $487 million deposited with this bank. Well, as I said before, the Fed was like, yeah, we really need to turn it up a notch so people start losing their jobs. Well, when these people started losing their jobs, he was like, oh, not those people. We want people to lose their jobs, but not these people. These are the wrong people. Okay, that's interesting. So what happened? After the Fed was like, nope, these are the wrong people. We don't want these people to lose their jobs. We don't want too much panic to ensue. I know that I have been raising the rates. I know that I probably should have started raising the rates back in 2021. And I know I got bullied a little bit by Trump when he was like, better not raise those rates. I ain't playing with you. Don't make me get on Twitter and talk about your mama. When we knew that the rate should have started going up to slow the inflation down, he opted not to. Waited a little bit too late. What they say, like a day late and a dollar short. Well, in this case, he was a day late and hundreds of millions of dollars, billions of dollars short. So in order to solve this problem, normally, if a bank goes out of business, and again, I'm sorry I can't show you the graphic, but the FDIC steps in. And the FDIC, what is the FDIC? Usually, if you're watching a commercial, like Wells Fargo, Bank of America, to say something, this FDI insured, it is the Federal Deposit Insurance Corporation. So it insures your money as a consumer, my money as a consumer, anything below $250,000. Now, this number was raised back in 2008, 2009. From $100,000. So it went from $100,000 up to $250,000 in insurance. Now, if you've deposited anything, like I said, less than $250,000 and the bank goes out of business for whatever reason, then you still have your money. Anything above $250,000 is a you problem. That is your business, your problem. You would think that people with tens of millions of dollars, hundreds of millions of dollars, would do their homework on depository institutions. You would think, right? Well, in this case, they may or may not have. I don't know. I wasn't there. Who's to say? But the FDIC's job is basically as an independent agency that's created by Congress to maintain the stability and public confidence in the nation's financial system. The FDIC ensures deposits, examines, and supervises financial institutions for safety, soundness, and consumer protection. So basically, they're there to make sure that you all, as consumers, know the bank is a safe place to put your money until this weekend. Like I said, y'all, nobody's talking to you if you don't have more than $250,000 in deposits. Okay, these people did, and so they came in. They said, "Don't worry about it. We got it." They decided that they would cover everything. They're going to make everybody whole. Even the company that I mentioned with the $487 million of exposure. Well, how do you do that? You get money out of thin air? No, you go to the printing presses and you start printing money. Printing money. I wish I could print money at my house. But, us little people, we don't get that luxury. And that is why people are very, very, very upset. One of the big concerns that people have right now is how is this going to, what is the response going to be with other banks? What are other banks going to do? What are people going to do? How is this going to impact, ABC Bank, XYZ Bank, Wells Fargo, so on and so forth? Well, the reason why the Fed stepped in as quickly as they did was to squelch or avoid what's called contagion. Basically, it's when things like this get out, kind of go viral, and it spills over to other banks. There is a list, and I will allow you to Google it. There's a list of banks that are considered to be at risk. And Moody's is a credit rating agency, and they have issued some downgrades. And I looked at the list. I used to work at one of those banks. So in the coming days, we are going to watch and see how does the market react, what's going to go on. Is this something that's going to spread like wildfire? Highly unlikely. And it's simply because they jumped in as soon as they did to make sure that this wasn't a problem. So whose fault is this? Joe Biden said that the leadership needs to be fired. I'd have to agree, probably so. I did hear that the CFO used to work at a company. If you could get, you could guess what company he used to work at. Company called Lehman Brothers. So again, history repeats itself sometimes, doesn't it? So right now, what we'll be looking for in the next coming days is the 2018 deregulation is probably going to be revisited effectively during the Trump administration. He rolled back some of the requirements placed on banks to make sure that they were considered to be sound in the event that things happen, like stress tests. They had to have a certain amount of capital on hand. They relaxed those guidelines. My bet is they'll probably go back to that, look at it again, and probably shore that up to make sure that we don't have this happen again. Will the interest rates be raised? That remains to be seen. I'm very excited to see, because literally last Tuesday at the same time, I was telling y'all that the Fed was like, no, we got to jack up those rates. We're going to go up higher, faster, because things are not working out the way that I'd hoped. Now we don't know. Honestly, this situation is a direct result of the interest rates going up too fast. One thing that Joe Biden said is that taxpayers are not going to be left holding the bag. Well, here's the gag. As I was doing my research, I learned that they're probably just going to give the banks special assessments, and those special assessments are going to pay back the government. Well, guess who those special assessments are going to be passed on to, probably in the form of fees? That's right. Regular people like me and you. So we'll see what happens. I don't know. But I said all of that to say this. What does that mean for mortgage? What does that mean for mortgage rates? Does that mean that, the bottom is going to fall out? Does that mean that a lot of houses are going to come on the market? Are there going to be waves of foreclosure and hysteria? Let's talk about that. So I want to unpack that. I can tell you one thing for sure. The FDIC that I mentioned before, they cover most banks, not all banks. And that's really important. Credit unions are not covered under the FDIC. The way that credit unions work is that they lend out their own money for mortgage loans, car loans, things like that. They make up their own rules. They have portfolio loans. And one result of this bank failure that you might see happening, or these bank failures, because I don't want to leave out signature, these bank failures is going to be, they're probably going to start to increase their cash reserves, and they're probably going to reduce or eliminate some of their products. They're probably going to increase the interest rates on some of those products to make them less desirable. So when you start to think about some of these loan products that are outside of the box, outside of Fannie Mae, outside of Freddie Mac, which I will say, by the way, this is a great reason why Fannie Mae and Freddie Mac should not be publicly traded. If you could imagine what that would have looked like with all of these things happening over the last 72 hours, it probably would not have fared very well for the housing market. But because Fannie and Freddie are under conservatorship, they're completely separate and inoculated from all of that. And so some of these products like bank statement loans, some of these products like the no assets, no income loan products that you see that will allow you to do some pretty unconventional things, they're probably going to start to be pulled back a little bit in the next coming days or weeks. So that's just something to pay attention to. Today, the inflation data came out, and inflation is basically the cost of a basket of goods year over year. What went up? How much did it go up? It accounts for everything that we buy, with the exception of energy and food, which I think is fairly convenient, don't you? Since gas is the most of the money that I spend and food is most of the money I spend. Like, who cares if furniture goes up? I buy furniture once every 6-7 years. So the core CPI is the amount of money that everything goes up year over year except gas or energy prices and food. And so today that data came out and it was down a little bit from last month. So we're right around the 6%. We really need for that number to be right around the 2-3%. And so from here, we're going to see what's going to happen, because again, last week, the Fed said to us that he was going to be jacking up the rates so everything would be able to, go down in value in cost pretty quickly. But I don't see how that's going to be possible. He'll probably have to slow it down. If he does continue to take the interest rates up, it's not going to be anything aggressive. But what we did see was, with all of this information, all of these things happening, we did see the interest rates did go down. If you were one of the lucky few that was able to have a interest rate locked yesterday, you would have found that your rate was down about 0.25% from what it was on Friday. So we're just going to have to pay attention and see, because I don't know. I don't know what's going to happen. I don't know when they meet later this month if that means that they're going to raise the interest rates, if they're going to leave the interest rates the same. I don't know if that means that they're going to, even lower the interest rates. But one thing I do know is that I read that we have about a $6.5 million housing short, 6.5 million unit housing shortage. So if the rates go down, I can guarantee you prices won't be coming down because there is a backlog of people that want to purchase homes, and they definitely will if they have the opportunity to have a lower rate and those payments become more affordable. So, all right. So that honestly went on a little bit longer than I expected, and it's okay. I mean, I wanted to get the information out to you. So I'll go ahead and start answering some of the questions that I got on my Instagram page, which is the Mortgage Boss. So if you're not following me, please go over and follow me on Instagram. So the first question is, what happens to a mortgage when a bank fails? What happens to a mortgage when a bank fails? You still have to make your mortgage payment. Some company will come in and eventually buy it by the bank. So over the last weekend, SVB did attempt to be auctioned. It didn't work out, but somebody will absolutely be purchasing it. If that, in this case, mortgages really wasn't a part of what was at play here. But in the event that, let's say, I don't know, Bank of America or, you know, SunTrust, which is no longer a company, so that's why I'm going to use them for an example. If, let's say, SunTrust went out of business in the morning, anybody that had a SunTrust mortgage would absolutely still have to make that mortgage payment come the first. I guarantee you it will go to somebody. So just because a bank goes under does not absolve you of the debt that was extended to you and the promissory note that you signed saying that you would pay it back. Somebody says, okay, are credit unions and smaller banks in the same boat? Yes and no. So I guess addressed this a little bit earlier. So are credit unions and smaller banks in the same boat? Yes. If for some reason a credit union goes out of business, somebody's going to come in and probably purchase it. Somebody bigger, a bigger fish will come in and purchase it. You will still owe a mortgage, a car payment, or what have you, whatever that debt is with that bank. Because it is not FDIC insured, my guess is you will find that in the next few days, weeks, and months, credit will start to be tightened. So I don't want anybody to think or feel that when things start going poorly, it's a good thing. Oh, the housing market is crashing. Yeah, I'm excited. If you are not considered to be a top tier client, customer credit profile, you're going to find that it's going to be even more difficult to obtain credit. The same way that things went belly up in 2008, 9, 10, 11. Well, we get to the bottom 2012, the market was at the bottom in terms of the prices for homes, but the only people that were able to take advantage of those homes were people with the absolute best credit. They had assets. They had to increase how much money they put down as a down payment. So you have to be mindful whenever something happens with a banking institution that creates anything that's considered to be a potential risk for them to lose money or lose even more money, they're going to find ways to fix that problem before it even starts. They're going to mitigate any further losses by controlling who it is that they are lending to. So please be mindful as these next few days may seem a little bit volatile. And as some of the headlines on the news might read, you know, interest rates plummeting. They didn't plummet. Um, you may find that you might be rooting for certain things to happen, but if Congress gets together and they said, hey, we need to take a look at some of the regulations, we need to add more, then they're gonna make sure that whoever they're lending to is not putting them at risk or putting them in a bad situation. Somebody says, should I wait until the crash to buy? What crash? What crash? It looks like there is an assumption here that there's going to be a crash. What crash? This is one bank. It's the 16th largest bank, and it is the second largest failure that we've had. But what crash? That was a commercial bank. It didn't have anything to do with consumers. And clearly the Fed is going to continue to print money and make things right and make people whole again. So there isn't an opportunity here for it to be a crash. Currently, we have 6.5 million home units that we need to have built to solve the deficit in housing. So as long as we have a gap like that for homes that need to be built, there's always going to be the issue of supply and demand. And the supply and demand issue is what's going to keep prices elevated, and it's not going to cause anybody to crash. Even if prices plummeted tomorrow 20%, that's really not an incentive for anybody to move. That's not, because they're going to go out and they're going to spend more money on rent. Rent is not dirt cheap like how it was, 10 or 15 years ago. If the prices go down, 20% tomorrow, they're still well above what they should have been to begin with. Home prices have almost doubled in the last 3 years. So even just a 20% deduction is still going to leave someone with a tremendous amount of equity. If someone lost their job and was forced to sell their home, they're going to have equity in the home. They're not going to sell it at a loss. So should I wait until the crash to buy? I doubt it, because there's no guarantee that a crash is coming. And I also want to say that a 20% swing is normal, which is why we ask for people to put down 20% when they're purchasing a home, to make sure that there's enough of a cushion there for the market to swing a little bit. Okay. Will this have a direct impact on people getting a mortgage? Will the bank failures have a direct impact on people getting a mortgage? Yeah, I'll say yes. Depending on the type of mortgage that you're applying for. If you are applying for a portfolio loan, which is again something that is considered to be like a loan with a credit union, or a loan that the bank is going to keep and not sell on the secondary market to try to recoup the money, they are probably going to be tightening up who they are lending to. If they choose to lend on those products at all, it is completely possible that if they find that this is widespread enough, some of the jumbo loans that, let's say you only have to put down 5%, they might rewrite the rules and say, oh, no, we need you to put down 20%. Some of these credit unions that I frequently lose to, I tell anybody all the time, I'm here to make sure that I'm providing the best service to you. And if I lose, then I lose. I'm okay with that. Here in Charlotte, the Charlotte Metro Credit Union, they beat me all the time. They have 100% financing, no mortgage insurance, and they'll lend to almost anybody. Their credit scores are pretty flexible. And so, for example, and I'm not saying this is happening, but just for the sake of an example, let's say it's XYZ Credit Union. XYZ Credit Union, it has 100% financing. If they look up and they realize that, oh my gosh, a lot of banks are starting to pull back on their lending. Maybe we should too. That 100% financing might be now they need you to put 5% down, or they may decide, we do have no mortgage insurance, at this fictitious ABC bank that I'm making up. So let's add some mortgage insurance or something like that. So Will it impact people getting a mortgage? Potentially, just depending on the amount of risk that lenders are willing to take on based upon what we're starting to see. Because, like I said, if we have anything that looks like that it is contagion, which what I said, it starts to, one situation starts to spill over into other banks, they are going to tighten up who they are lending to. That is why I am constantly encouraging people, stay ready so you don't have to get ready, and have some money, because the big losers in things like this are people that barely qualify, people that have barely a 580 credit score, barely a 620 credit score, barely have 3% down to put down as a down payment. These are some serious times when you start to think about the market shifting from what it was 3 years ago when it was a free for all. Now, when we're starting to introduce the idea of banks failing, do you think the bank is going to be your friend? No, they are going to protect themselves at all costs. Okay. So the next question is, how does a retired person what does a retired person need to qualify for a home loan? That's a good question. Income, any source of income. So if it's Social Security, pension, we'll just get the 1099s that they get at the end of the year, because any income that someone receives is accounted for to the IRS. And so at the end of the year, you should receive a 1099. This is including if you won money in Las Vegas, you'll get a 1099 at the end of the year and make sure that you're getting taxed on it. So in this particular case, for someone that is retired, if you have a pension or if you are receiving Social Security, we would ask that you provide your 1099s. If you have to file taxes, then your tax returns. We would ask for a letter, so your award letter saying that you get $3,000 a month in pension and another, $2,000 a month in Social Security. And then, of course, any bank statements that will be required to show your assets. If you have asset stocks, things like that, all of that would be collected. So, despite common myths, you don't have to have a job to qualify, but you do have to have income to qualify. Most people's income comes in the form of a job. So if you are someone that is fortunate enough to just have, you know, a lot of real estate properties that produce income for you every month, we would just gather that. So regardless of what age you are, a job isn't necessary. It's the income that the bank is looking for. How do I know if I'm getting a good deal? I want the lowest possible rate so my mortgage payment won't be as high. How do I know if I'm getting a good deal? I want the lowest rate possible so that my payment won't be as high. So, the lowest possible rate on the rate sheet. So, on the rate sheet, we don't have a thing called like the rate of the day, right? If you call and say, hey, what's your rate? And I say 6.875, that's going to be on a continuum of rates that may be above that and rates that may be below that. Well, Joy, why wouldn't you just give me the lowest rate? Of course, I want the lowest rate. Well, every single rate on the rate sheet comes with a corresponding number indicating how much that rate costs. So the rates stay the same. What happens is the number that corresponds with it in terms of how much it costs is what changes all the time. And so asking for the lowest rate, I'll be honest with you. When I was in the call center and people would call and they would have an attitude and they wouldn't want to allow me to do a proper consultation. Excuse me. When people would call and they would not allow me to do a proper consultation, just give me the lowest rate. Okay, 2%. Without explaining that 2% will cost them, I don't know, $25,000. the lowest rate may not be the best rate for you. You want to talk about your assets, how much money you want to put in this, what type of payment you want. There are a lot of different goals that you can have when you are trying to get a mortgage loan. And one of the biggest pet peeves I have is when people are not able to articulate what their goal is, and they're only able to say what they think I want to hear. I want the lowest rate. Well, why? What are your plans with the property? How long are you going to live there? An ARM might be the best rate for you. Um, you know, just it could be a lot of different ways to customize it to what it is that you need. I had someone contact me about a month ago, and the person was adamant about making sure that the payment didn't exceed, $1,900. I sent back something that was around $2,000. But then I got an email back saying, well, I didn't want to spend this much money. Well, you never told me that. You have to articulate what the goals are. And those goals can change all the time. But because I didn't know that information, led me to follow the directions that I was given. Okay, what do we need to do to keep the payment where they wanted it? And I executed. So asking for the lowest rate can sometimes be something that's very costly. And it could, in fact, exceed how much money you have available to fund the loan. So you want to make sure that when you're speaking to a loan professional, you are able to articulate in a very clear order, a hierarchy. What is the most important thing to you in this transaction? Is it your payment? Is it your out-of-pocket expenses? Because it can change for everybody. It is not going to be the same, and it's okay. It's completely fine. There are people that will spend, an extra $5,000, $6,000, $8,000 in closing costs because they've already calculated out how long they're going to live there. They've already calculated out their break-even point. They know they're not going to refinance. There are certain things that they know that they're going to do or not do that's going to allow them to yield a monetary reward. So asking for the lowest rate is not always the right question to ask, and it's not always the best question to ask or the best thing to demand, depending on your circumstances. All right. Next up, I don't work, but my husband makes over six figures. His credit score is below a 580 and mine is 742. Can we get the loan in my name since his scores don't currently qualify? No. So you cannot. We cannot include anyone on the mortgage loan without including that individual's credit report. By definition, one of the six pieces of a credit application is the score. And so there would be no way to include their income without having them on as an actual applicant. So I would recommend just working on getting his credit up to par so that the both of you could go on the loan if that's the route that you want to go. If you're not bringing any income to the application, you can absolutely be on the loan, but depending on the full details of everything, it may not be beneficial. Your 742 credit score does not bring up the lower credit score. We are going to be more conservative and again mitigate risk, because it's always about risk. Like what is the risk that we're taking on by having this person walk away with $400,000? Your credit score is not going to help benefit Well, it won't hurt, but it doesn't, create a situation where it's like a overwhelming amount of difference. When the DU findings or automated underwriting system reads the loan application and it sees that it's more than one applicant, that can be favorable. At times, it definitely can. However, in terms of the rate that you qualify for or the pricing that you may qualify for, it's indifferent. It doesn't help in that regard. If your salary is $65,000, how much house can you be approved for? A simple mathematics equation when it comes to debt to income ratio, figure out whatever your month to month income wages are and divide by 2. And that's how you'll know how much you'll be able to afford in total debt. Whatever that number is when you divide by 2, you need to make sure that you include any car payments per month, student loans per month, and any other installment debt that you have per month, and the mortgage payment. All of that combined will give you a total debt to income ratio. So, for example, let me pull up my calculator. So $65,000 per year divided by 12, because everything we do in mortgage is based on a month-to-month scale. That gives us $5,416. In most cases, when you're talking about a conventional loan, we're talking about 50%. So 50% would divide by 2. That means that the absolute maximum debt for this individual is $2,708. That $2,708 might be the mortgage payment all by itself. Now, if we go and we sprinkle a little bit of student loan debt in there and a car payment, let's see how much they will have left over. So for the person that is allowed to have $2,708 per month in total debt, let's say they have a $525 a month car payment, and let's say they have $100 in student loans per month. That leaves them with $2,083 available for a mortgage payment. And roughly $2,000 for a mortgage payment is a little over $200,000 as a loan amount. So including taxes, insurance, mortgage insurance, all of that. So that's how we figured that out. So it's challenging for me to say, oh, if you make $65,000, here's how much house you can get, because there's other factors that are factored in, and it's based on how much debt you have that you are bringing into the situation. So really quickly, one more time, take your annual income divided by 12 for your monthly income. Just for a rough number, divide your monthly income by 2, and that tells you the maximum debt that you can carry. If you have other debt already on your credit report, start subtracting. Subtract out your car payment. Subtract out your student loan payment. If you have a kid and you pay child support, if that's not already listed on the credit report, go ahead, subtract that out too. If you have installment debt like a furniture bill, subtract that out. Whatever number you have left after you subtracted your minimum monthly payments, credit cards, all of that, whatever that number that is left determines how much monthly payment you qualify for. And I want to make sure that I'm being very clear. We do not qualify you for a particular purchase price, so to speak. We qualify you for a mortgage payment amount. Depending on the interest rates, that mortgage payment amount is going to equal, or be correlated with whatever a purchase price is or a loan amount is. And so in most cases, as interest rates go up, your number is still fixed. If you can do $2,700 a month, if $2,700 a month, if rates are 10%, only gives you $150,000 house, I don't know what that equals, I'm making it up, then that's how much house you can get. If the rates are 2% and $2,700 is going to let you get a $500,000 house, which again, I don't know, I'm making it up, then that's how much house you can get. So you're qualifying for a number in terms of a payment amount, not an actual housing amount. That housing amount is just based on whatever the market is at that time, based on like whatever the interest rates are. So please be mindful of that. Okay, it is 8:02. One more question. Okay. So a friend of mine closed on her house a couple of years ago, and she said that the lender told her that the rate was a fixed rate, but she said that her payment increased at the beginning of the year. How can a lender bait and switch like that? The lender did not bait and switch. One of the reasons that I'm guessing the payment went up, especially when you're talking about the end of the calendar year, the beginning of the calendar year, is based on the adjustment in property taxes and or homeowners insurance. The only thing that's fixed about a mortgage payment is the principal and interest payment if you have a fixed interest rate. That's it. The other factors that are in your payment include your principal, interest, property taxes, homeowners insurance, mortgage insurance, and homeowners association dues. Well, you don't pay your homeowners association dues to the bank. So these are the other things. So the principal and interest is what it is. But depending on what is going on in that neighborhood, the the insurance rate could have increased, which would increase how much they're paying year over year. If they had a claim, that may have had something to do with the insurance going up. Usually that's not the situation. More often than not, 9 times out of 10, it's the tax rates that are increasing. And in Mecklenburg County where I live, we don't have like an annual increase in property taxes. We increase every 6 years. And so when I moved into my home, I'll tell you my thing. So when I moved into my home in 2017, the valuation for my house, the home value or the taxable value, I believe was 205, if I'm not mistaken. I assure you, when the new tax bill comes, it is definitely not going to be taxed at 205. My tax bill is going to be much higher. And so because I do pay my taxes and insurance in my mortgage payment to my lender every month, my payment is going to go up. So all of these home values that have skyrocketed in the last 2 to 3 years, you will see a difference in your payment because your tax bill will in fact increase. So it has nothing to do with a bait and switch. If you got a fixed rate, you got a fixed rate, which I know was indicated on the loan estimate. So you can have your friend just look at her loan estimate, which is provided during the transaction as well as on the closing disclosure at the end of the transaction. I'm positive that it says it's fixed, but your payment can in fact increase on a fixed rate if your property taxes increase, which they will, and or your homeowner's insurance increases, which it can. But if your homeowner's insurance is increasing, you can just shop, just call another insurance company and maybe see if you can get a little bit lower insurance rate for your home. So I hope that was helpful. It is about an hour in, so I'm going to go ahead and close this out. You all, thank you so much for joining me. I hope that this was something that was entertaining and educating. I know it was a little bit boring in the beginning, but I did want to make sure that I addressed what was going on with SVB Bank. Let you know that just because they are no longer, functioning does not mean that that is going to happen to your bank. If you have $250,000 in the bank, well, first of all, why do you have $250,000 in cash in a bank anyway? It should probably be in investments, but that's another story for another day. But if you happen to have an excess of assets, you may want to take a look at separating them amongst other banks or something like that. But again, it was important to me to at least address the breaking news and let you know that everything is going to be fine. Can this spill over to another bank? Potentially it can. Is this going to impact mortgage rates? Potentially it can, because the Fed may have to reevaluate the strategy in bringing down inflation in the coming days and weeks. We will see as more developments occur if they'll just slow down and say, maybe we don't need to jack up rates really fast. Slow and steady might win the race. But one thing I know, one thing about it, two things for sure, the only way to bring inflation down is to increase the interest rates. So we either going to just continue to have inflation go up and up and up, or rates going to go up. So we'll see what happens, but I appreciate you all spending a little time with me. If you have any questions, let's keep the conversation going in the comments. Please put your questions below. Hit me up on Instagram. Again, I'm the mortgage boss, so the_mortgage_boss. I'm happy to see what I can do to assist you, and I'll see y'all here again 7 o'clock next Tuesday for another Mortgage Boss Talk Tuesday. Y'all have a good day.